On a Friday in October 2025, Wall Street was rocked as the U.S. stock market lost $165 trillion in a single day. The S&P 500 plunged 2.7%, its worst drop in half a year, a direct response to a dramatic escalation in the U.S.-China economic standoff. The trigger: President Trump in his second term announced a 100% tariff on all Chinese imports. This aggressive move sent markets into panic, with investors fearing a trade war that could cripple supply chains and spark a recession. For millions of Americans, this wasn't just numbers on a screen, it meant shrinking retirement accounts and lost savings overnight. The White House framed the tariffs as a defense of American jobs and national security, but critics warned of severe blowback for consumers and businesses. Vice President J.D. Vance called it a matter of national security, while business leaders braced for economic pain. The shockwave wasn't just financial, it raised urgent questions about the risks of high-stakes economic brinkmanship. Would this bold strategy force China's hand, or plunge the U.S. into a prolonged downturn? The stakes were clear: $165 trillion lost, and the future of the economy hanging in the balance. The world watched as the U.S. gambled on economic shock therapy. To understand Trump's drastic move, look to rare earth minerals, 17 elements essential for everything from smartphones to missile systems. China controls 70% of global mining and 90% of processing, giving it enormous leverage over the world's tech and defense industries. In October 2025, Konferensen Kaiken San Dinner 25, Droban Bay, Abondeberdening Eindroen. Beijing tightened its grip, requiring special approval for any product containing Chinese rare earths to leave the country, even if assembled elsewhere. This move threatened to choke off global high-tech manufacturing and was seen in Washington as a direct economic attack. The Trump administration called it a national emergency, arguing the U.S. couldn't let a rival control its technological future. The fear: China could cut off supplies at any moment, halting key American industries. The rare earth standoff exposed a critical U.S. vulnerability and forced an immediate, overwhelming response. Trump's answer: tariffs, aiming to break China's stranglehold and force a new deal. The stage was set for a showdown with the global economy caught in the crossfire. The rare earths crisis made clear that supply chains are now weapons in a new kind of economic warfare. The U.S. had to act or risk being held hostage by China's dominance. The world braced for the fallout. Trump's response to China's rare earth controls was the nuclear option, a 100% tariff on all Chinese imports, effective as soon as November 1, 2025. This would double the price of $420 billion in annual imports overnight, hitting everything from electronics to clothing. The administration argued this pressure would force China to negotiate, while tariff revenue could support U.S. industries and farmers hurt by retaliation. Trump projected confidence, but details on aid for affected sectors remained vague. Supporters saw this as a necessary shock to reset trade relations. Critics warned of massive inflation and economic disruption. The market's $1.65 trillion plunge signaled deep investor skepticism. The gamble: could the Could the U.S. economy outlast China's, or would both sides suffer? The tariff threat marked a turning point. High risk, high stakes, and no guarantee of success. The world waited to see who would blink first. China's response was swift and strategic. Beijing announced a 20% tariff on U.S. soybeans, targeting a key American export and political base. The move was designed to inflict maximum pain on U.S. farmers and pressure the Trump administration from within. China also imposed new port fees on American ships, mirroring U.S. actions and raising costs for global trade. These measures, combined with rare earth controls, showed China's willingness to escalate on multiple fronts. Beijing's message: it's ready for a prolonged fight and won't back down. The tit-for-tat strategy increased costs for businesses and consumers on both sides, deepening the economic rift. China's playbook now includes targeted tariffs, regulatory hurdles, and reciprocal penalties. The trade war had become a broad, multi-pronged conflict with no easy off-ramp. Both nations signaled they were prepared to endure pain to defend their interests. The world economy was caught in the crossfire. Nowhere is the trade war's impact more devastating than on America's soybean farmers. China, once the top buyer of U.S. soybeans, has slashed purchases by over 50%, leaving American silos overflowing and prices in freefall. Soybean prices have dropped 40% in 3 years, pushing many farmers below break-even and into bankruptcy. Farm bankruptcies have surged 50% since 2024, as families lose multi-generational livelihoods. Trump's promises of tariff-funded aid offer little comfort. Previous relief packages couldn't replace lost market access. Farmers want trade, not aid, but their biggest customer is gone, and new buyers are hard to find. The crisis exposes the risks of relying on a single export market, and the vulnerability of U.S. agriculture to global shocks. Diversifying markets is easier said than done, and the pain is immediate and personal. Rural America faces mounting debt, vanishing profits, and an uncertain future. The trade war has turned prosperity into crisis for the heartland. Farmers are left hoping for a diplomatic breakthrough that seems increasingly unlikely. The stakes for American agriculture have never been higher. As U.S. farmers struggle, Brazil and Argentina are seizing the moment. With China turning away from American soybeans, South American producers have ramped up exports, capturing the lucrative Chinese market. Argentina's suspension of export taxes made its soybeans even more attractive, undercutting U.S. prices. Chinese buyers are investing in long-term deals and infrastructure in South America, making the shift hard to reverse. American farmers, who spent decades building trust with China, have seen their market share vanish in months. The realignment may be permanent. Even if the trade war ends, the U.S. may never fully regain lost ground. The global market is unforgiving, and competitors are quick to fill any void. The lesson in trade wars: lost opportunities are rarely recovered. This isn't America's first trade war with China. The 2018-2019 conflict saw billions in tariffs, lost exports, and massive federal aid to farmers, aid that proved a poor substitute for stable markets. Tariffs were meant to punish China, but caused collateral damage at home: higher prices, disrupted supply chains, and economic uncertainty. The belief that China would quickly yield was mistaken. The dispute dragged on, hurting both economies. The Phase 1 deal left core issues unresolved, and tensions never truly disappeared. Trade wars are easy to start, hard to end, and often spiral into cycles of escalation. The current crisis echoes the past: blunt tools, unpredictable fallout, and American farmers caught in the middle. History warns that there are no quick fixes, only hard lessons. For everyday Americans, the trade war means higher prices on everything from phones to clothes. Retailers will pass on costs, acting as a hidden tax and fueling inflation. Businesses face chaos in global supply chains, risking layoffs and stalled growth. The $1.65 trillion market drop reflects fears of recession and economic instability. Beyond wallets, the conflict signals a shift in U.S.-China relations, from engagement to confrontation. The administration calls it necessary to protect American interests. Critics warn of a new Cold War and global instability. The world stands at a crossroads: continued escalation or a return to tough diplomacy. The outcome will shape not just prices, but the future of the global economy and geopolitics. The stakes couldn't be higher, and the world is watching.